Eastern Daylight Saving Time. Please, if you could just affirm that you can see me and you can hear me, just type in this box down here. Can you see me? I see June's on, Tina's on, somebody's on the phone. Testing, testing, one, two, three. Can you hear me? And can you see me? That's all I want to make sure of. I know a couple of you are on your phones, but if you can type in the chat box and confirm that you can hear me, it would be much appreciated. I'm going to give folks a few minutes to get on, and then I'll start with my introduction and we'll get right started. Can you hear me though, guys? Just want to know. Good, Deb. Hey, Deborah Brady, welcome. I was just looking to see if you got the registration. Can you hear me, Deborah? If you could type in the chat box. Can you hear me and can you see me? You cannot hear me. Okay, so let's see what's going on here. Can you hear me now? Testing one, two, three, testing one, two, three. Okay, so Tina can hear me, but she can't see me. Okay, Deborah, you can see me. Can you hear me yet? Testing one, two, three. Can you hear me? Hi, Gail. You just got on. Can you hear me? So June can see and hear me. Excellent. Okay, so you may have to log on and log back off, but I think right now I should be in good stead. So June can see and hear me. Gail, I know you just joined. Can you type and tell me whether or not you can see and hear me? Okay, perfect. All right, well, I'm going to get started. And if you can't see or hear me, you might have to sign in and sign off. But thanks everybody for tuning in with me. I think we're at maximum capacity this evening just based on registrations. But that doesn't always mean people are going to show up. But for those who don't know me, I'm Deborah Owens, America's Wealth Coach. And tonight I'm going to be talking about what's in your purse, the 7 wealthy habits of successful women. And the reason why I want to talk about this evening, ladies, is I saw this, what I thought was an amazing statistic. And it said that half of all women have less than $1,000 saved for retirement. And if any of you have watched me on News One Now or follow me on social media, you know that I'm on a mission to change the financial condition of women. And just I'll briefly go over just a little bit about myself for those of you who are joining and don't know me. I help women, well, I help all people, all individuals overcome their financial fears and build 7-figure portfolios. So if I've got some gentlemen on the line, that's okay too, because this message is made for a woman this evening, but it's strong enough for a man too. At least that's what I always like to talk about when I talk about the A Purse of Your Own campaign. Deb, I think you're the only one who can't hear me, so check your audio, check your settings. Okay, so I'm creator of the Purse of Your Own campaign to financially empower 1 million women. I have a segment that airs on News One Now on TV One called Wealthy You, where I share tips on how you can begin to make the shift from income to wealth and learn how to invest. I am a 20-year, really a lot more than that though, veteran of the financial services industry, and I spent most of my career with Fidelity Investments, and I just really had a passion for wanting to kind of transfer what the knowledge that I've learned to others. And so Fidelity was very, very supportive of that. They sponsored my first radio show, and then I decided really many years ago to go out and share with folks how anyone at any income can build wealth. And as a result of that, I've written several books. Most recently, we updated my book, Nickel and Dime Your Way to Wealth, and that's about the parking attendant who amassed $1 million portfolio. And I'm also author of A Purse of Your Own and Confident Investing, a wealth building guide for women, and Every Woman's Money. And long story short is my goal really is to make financial security attainable, to let you know that it is within reach. But what I'm going to be sharing with you really is insights that I've learned just in my work in coaching and what you need to do to make the shift, because we are in a different economy. And in order for you to have a full purse, and that when I say purse, I use purse as a metaphor for wealth, or wallet can be a metaphor for wealth. But in order for you to accumulate the kinds of assets at retirement that are going to last throughout retirement, you've got to do things differently. So I'm going to talk a little bit about how to make that shift. But before we get started, I want you to all know that this is an interactive presentation. And so you're in what is called, this technology is called Click Meeting, and you're looking at a similar screen here, so you should be able to see me over here, just like before I was little Shirley Temple in that picture with curls. But if you want to make any kind of comments, you just type in the box down here, and you can go ahead. If you want to comment as I'm going through the presentation, please do. I see there are a few of my wealth coaching students on the line, so on attending the webinar as well. And so I'd love for them to comment as well, just from your perspective, because I think it's important. So often when I'm telling people, sometimes they can feel like it's not for them, but it's wonderful that both Gail and Deborah are on this evening so they can kind of share what their experiences are. And I know I saw a few other wealth coaching students register, so we'll see if they're going to join us tonight. But for now, I want to talk a little bit about what we're going to talk about in the night. So just an overview. I'm going to talk about the shift from income to wealth and the fact that we are in a dynamic economy. And what if I told you that everything that you've been taught, get a good job, go to college, get a good job, you'll have enough at retirement. What if I told you that game has changed? Would you agree? Would you agree that the game has changed? Absolutely, it has changed. And yet, I'm amazed when I talk about this, how people are like, how come nobody's talking about this? Well, the fact is, what you're going to learn tonight is that we've been going through this change for years. And what we all have to get accustomed to is navigating our lives in an uncertain environment. And on the one hand, it can be kind of scary. And that's what I've learned through wealth coaching, that there is a lot of fear out here. And typically, what happens when you're fearful, though, fear can be paralyzing. I mean, to the point where we just we don't do anything. And in fact, one of my wealth coaching students put it this way. She said, I just got comfortable in my fear. I just got comfortable. But let me tell you something. It is at your point of fear that you have to act. That's when it really takes courage for you to act. Because you know, when you're fearful, it means that you never went beyond that point. And because you never went beyond that point, that's why you're afraid. But once you get beyond that point and you say, oh, okay, I get it now, guess what? Your confidence builds. And so that's really why I created wealth coaching, is because what I've learned is that when people hit that wall, if somebody's not there for accountability and support, they stop right where they are. And guess what happens? They don't do anything, or either they hope things will work out. And one of the things you'll learn, and one of the things I know to be true, is hope is not a strategy. So tonight, what I'm going to talk about is making the shift from income to wealth, learning, what you need to do. All you need to do is acquire financial acumen. Then you need to make sure that you, in this environment, that you're not relying on just one thing. Because relying on just one thing or one form of income, that's another way that fear can overtake you. Because at any time, somebody can come and they can say, oh, I'm closing down this department, or we doing a restructure, or we doing reorganization. So you've got to learn how to increase your tolerance for risk. And you know what? You've got to learn to even just embrace this uncertainty, to the point where, and I'm telling you, it's not easy. I'm an entrepreneur. Nobody writes me a check. I have to make people, I don't get a check every week. I have to make those checks happen. But that's what I want you to understand, is you've got to be in an entrepreneurial mindset. Then, no matter where you are, you got to maximize your retirement plan contributions. And I'm not talking about just as much as the employer can match. So I'll talk about that a little later. What kind of level of savings you have to have. Then you've got to optimize your investments, meaning that you can't just be trying to be safe. You've got to learn how to make your money grow. And when you do that and learn, then that becomes calculated risk. And so to expect your money to go up and down, but you've got different eggs in different baskets. So we're in a new economy, and the bottom line is, if it is to be, it is up to you. So you have to learn how to close your personal wealth gap. And so what it means is you got to earn more income. Listen, Now, this is the one thing I want you to understand. If you're standing still, you're moving behind. Okay, meaning you can't afford to just sit in one job anymore. Okay, and in fact, if you just stay with the same person, the same job, they're probably gonna just give you a little 2 or 3% raise, and 10 years will go by, and you're like, man, I'm still not making enough money. Anybody not agree with that? You agree with that? I mean, I can tell you, I love millennials because when it's not working out for millennials, they keep it moving. So I'm telling people we need to all get a millennial mindset. I have 2 children. One is a millennial and one is, I guess, whatever that one was before that. But anyhow, they keep it moving. And that's what we have to do, right? Because, I look at them and, my son has had has quadrupled his income in the past. Maybe he's only been out since 2009. He is not playing. Okay. But the other thing, so you've got to, while you're in a position, you've got to be looking for your next opportunity. So you got to know while you're in that position what your next move is. I say it's the difference between playing checkers and playing chess. Okay, so the first thing when I'm coaching people, we have to figure out is where are we trying to get on the board? What is our goal? Okay. And so that then strategically we can begin to make those moves so that we end up where we want to go. But oftentimes I can tell you this, people don't even know where they want to go. Right. So they just keep on keeping on thinking things are going to change, and things are only going to change if you make it so. And the other opportunity, and one of the things I really want to talk about, because I was just having this conversation with someone, is the reason it's important for you to know where you're going is because then when someone asks you, you can tell people, and that's how people can help you. But when somebody says, oh, well, Deborah, so what's up? What are you up to? What are you trying to accomplish? Well, here, this is my goal. I want to be here. I want to have my own this. I want to, I want to hit this in revenues. This is where I want to be. So I can clearly convey what my value proposition is. And so if they can't help me, if somebody else comes into their orbit that can help me, if I've conveyed the right thing to them, they can say, oh, I was just talking to Deborah Owens. That's something that she was looking at doing. Maybe you can assist her. I'm building an app right now and finding funding. And so I tell people I'm building an app. I want to talk to people who've done it, and I need to be with people who are able to make that happen. So once you know where you're going, where you are, you're looking at finding another opportunity. And the other thing, closing your wealth gap, there are only 2 things you can do. Okay, you either got to make more money or you got to create more income. And I will tell you, if you will focus on the growth side of it, I'm not saying don't cut expenses. It's good to be frugal, but there's only so much you can cut. And whatever you focus on expands. And if you begin to focus on how you can create opportunities and how you can build more wealth and how you can market or sell your skills, then that's going to give you a greater capacity. And the other thing that happens when you have a wealth mindset, some people call it a growth mindset. I call it a wealth mindset. So you're not looking at what you don't have, you're looking at what you can make happen. When you start thinking about what you can make happen, it's amazing what happens. Is this making sense? So, I mean, it's just a total shift. It's not settling. It's understanding that every day you have to grow, because that's what a wealth mindset is about. If you go to my website, I say wealth is more than material possessions. Wealth is not material possessions. It's the value you create. And so what I'm talking about today And what the whole framework for my training that I'm not going to go into this evening, but is the 7 wealthy habits. And that's the attitudes, beliefs, and the behaviors of financially successful people. And the bottom line is financially successful people, they are able to create wealth because they create value. They do more than what's expected. And as a result of that, they end up in a different place than most people. Make sense? So it's not enough to make money. Then you have to increase your financial acumen and make your money grow. And you do that by taking calculated risk. And here I have some examples. Ursula Burns, she started out as an intern with Xerox and then became a CEO of Xerox. And when I look at her, she is the epitome of a woman with a wealthy mindset. Lisa Price, you guys know her story. She started Carol's Daughter based on a recipe from her mom in her kitchen. She went on to be one of the first African American women to cash out and take her and be acquired by L'Oreal. And then Janet Bryan Howroyd, a lot of people don't know, but she is one of the first African American billionaires and did it with a staffing company. So why I'm saying that everybody has the capacity to create opportunities for themselves, and typically those opportunities are right in front of you, but you have to get clear and understand the macroeconomics that are happening around you and how you fit into that puzzle. And so that's what I want to talk about this evening is closing your wealth gap and making sure you have enough in your purse. And in order to do it, you need to understand the the psychographic, the demographics of what are happening and how you fit and how you can leverage this change, because change dynamics are good. You just have to look at the problems that are caused by this change and figure out how you can add value by solving those problems. That's the bottom line. So, okay, so I'm going to get off my soapbox because there are a couple of things that I wanted to double click on tonight. So, here's what I want you to get clear. So, before I start, anybody disagree, agree, not agree? I mean, am I walking down your street? Do you have a wealth mindset? Are you still sitting back thinking things are going to be all right? Are you doing the I'm hoping and a wishing? Okay. Hope is not a strategy. Okay. I'm going to stop. No, I'm not going to stop saying it because it's true. It's not. Okay. So what are we looking at? The current shape of things. Basically, I think hold on. I'm a highlight this a little bit. Okay. So basically what we're looking at is the average number of jobs in a lifetime now. So remember when you used to work for one employer and then you get a pension? Look at this. The average male will have 11.4 jobs. The average woman will have 11 jobs. But what they don't say is the average woman will be out of the workforce sometimes an average of 11 years. Sometimes we come out to raise children. Sometimes we come out early to take care of our parents. And the implications of that are that, we're moving around these jobs. What do you think happens? As we move jobs, what happens is we don't get vested. If sometimes we don't stay there 5 years, right? Meaning we don't have a pension. And then the other thing that happens is if we have assets and we're moving from job to job, we got to make sure we're taking those assets with us and we're keeping them deployed. And a little later, I'm going to talk about the implications of not doing that. Okay? And so if this is true, if this is what this new economic environment looks like, it requires a different approach. Would you agree? I mean, would you agree that if this is true, then we need to be thinking a lot more strategically about how we're saving for our future? The bottom line is we have to acquire the first habit of a wealthy outlook. That's the habit of adding value, and make sure that we're contributing, you know, at least 10%. But the studies show that the people who are most prepared at retirement are contributing about 15% until their retirement plans each year. And so what that requires really is a discipline, but not only a discipline, but that when we're investing, that money is growing. You know, many folks are savers and they do save, okay, but it's not enough to save, and I'm going to show you why. You got to get that money working for you, okay? And but here's the truth. The reality is that how many of us even have what is called a pension plan anymore, where does anybody, so who on this call today has a fully funded pension plan that their employer contributes to? Anybody? Their employer contributes, and then when they retire, they're going to get a certain amount. Anybody? Okay, FedEx, right? Okay, you're retired already on a pension. Okay. Anybody else? Okay, so you are. So are you, so, but here's how many of you have 401k plans also that you're contributing to? Okay, so what this chart you're looking at, and if you've been to any of my webinars, you know I love showing charts. And the reason that I do is because what it shows is, okay, 401, 20 years in. Excellent. Okay, so the key really is, and this is what this chart says that in 1979, 62% of employers only had a pension plan. And in 1979, only 16% of employers had what is called a 401k plan. Now that has shifted, right, to where 70% of employers have defined contribution plans only, and only 24% have a defined contribution plan or a pension plan and a defined contribution plan or 401k or 403b. So the implications of this are that you are now required to invest and make your money grow. And unfortunately, nobody really taught anyone how to manage their money. And so as a result of that, what I find is that many people in 2008 came out of the market. They were afraid. They thought they were going to lose their money. So they put all their money into the fixed contribution plans. And basically those plans are barely paying 3% guaranteed. And so as a result, they don't compound, and people don't have enough money in their purse at retirement. And for those of you who are retired already, the fact is that you could live another 30 years. And will that pension alone be enough to keep up with inflation? And, you know, I just want you to think about it. So I'm just going to ask this question. How much did a loaf of bread cost 10 years ago? So it's 2007, you went in the store. How much did a loaf of bread cost? Anybody remember? Come on, I know some of you guys are grocery shoppers. Well, in 2007, the average cost of a loaf of bread was about $1.50. Okay, so how much does a loaf of bread cost now? How much? Over $3. That's right. And if you're shopping at Whole Foods or whatever, it's almost $4. So, and just, but I'm going to use your number, Wanda. I'm going to say that A loaf of bread costs $3. So in just 10 years, what we've seen is the loaf of bread double in cost. And so then my question becomes, has your income doubled? Has your pension doubled in terms of if you're on a pension? Or has your income doubled in the past 10 years? No, because what we are seeing is we're seeing that, and I'm not going to show that chart tonight, but what we've seen is that incomes have basically decreased. You know, some people in their first jobs are earning what I did 25 years ago. Okay, so the only way to give yourself a raise in this environment really is to learn how to deploy your assets. And so in order to do that, this is what you have to take it. So what's going to be in your purse? So you're going to have Social Security and a pension. Some people are going to have pensions, some not, right? You have your employer-sponsored retirement plans. That's your 403Bs, 401Ks, those sort of things. You have your individual retirement accounts, and then you have your tax-deferred annuities. And so those are like what's going to be in your purse. And whether or not you're going to have enough in your purse depends on how you manage and grow those assets. That's the bottom line. And so what I love to do, and for many of you who've been on this on my webinars before, I show this chart a lot because I want to give people a sense of, based on where you are in your age, how much you should be targeting to save. And basically what this chart shows is how much you should have saved at different ages. So at age 30, you should have 1 times your salary. At 35, you should have 2 times your salary. At 40, you should have 3 times your salary. At 45, you should have 5 times, and on until at 67. And those people who are most prepared for retirement have hit that target of 10 times their annual salary. Now, a lot of this depends, though. If you have a fixed pension, that is going to then, of course, diminish the amount of savings that you need to have in order to keep you, on point when you retire, or so that you don't run out of money. But the key here is not only the way you're going to get to this number, and I will tell you, has less to do with how much you put in and more to do with how you make that money grow. And this is the key to it. This is the key to it, is that if your money is not compounding, then it doesn't grow rapidly enough. People always, when I say 7 steps to 7 figures, they're like, oh, well, I can never save $1 million. Well, if any of you read my book, Nickel and Dime Your Way to Wealth, you know that Mr. Earl in my book never made more than $12 an hour, and he was able to hit $1 million, which was a lot more than that. Was almost 20 times his annual salary. But the point is that the reason that he was able to achieve that number was because his ability to invest and make his money grow more rapidly. And that's really the key. The key is understanding how to make your money grow. And that's where many folks lose out. I mean, one of the first things that I do in wealth coaching is to review and analyze how people have allocated their assets. And oftentimes what people are doing is they're keeping it in what they believe to be safe because they can't afford to they don't want to see their money go down. But what happens is it doesn't compound. And so the other chart that, this is fundamental to learning and building your financial acumen, is just understanding what kind of expected returns you could earn in different asset classes. Oh, I'm breaking up. Can you guys hear me now? Is that better? Good. Okay, sorry. You guys know I get a little I get into this stuff because I want you guys to know. And basically, if you've been in any wealth coaching or any of my other webinars, you know this right here. This is the long-term performance of different asset classes and how they've performed over time. And the biggest thing you have to understand, let me make this a little bigger, is inflation. And inflation is this thing right here, this gray area. And what it shows that from 1926 to 2013, I'll update this, inflation has averaged about 3%. And so that inflation is the cost of goods and prices rising. And it's what happens when 10 years ago a loaf of bread cost $1.50 and now it's $3. And so in order to even get money, making money off the bat, you got to earn at least 3% or you're like sitting still. And so think about what has happened when you look at interest rates. What are you earning on your bank accounts right now? Anybody know? What are you earning? What can you earn in a CD? What can you earn in a CD? Tell me, guys. I know you got some savings and you're getting a little interest payment or dividend payment. How much is it? It's 1% if you're lucky and you're in a savings account, and if you're in a CD, it's at 3%. So you're treading water. You're not even out the gate. You're not even beating inflation. And so, and that's what a treasury bill is. That's where banks put your money market funds, money market accounts, money market mutual funds. They've averaged about 3.5% historically. So that means they've been up, they've been down, they've been up, they've been down, but this is what they've averaged, 3.5%. So you're barely above inflation. And then if you put it into something like a government bond so let's just show you. So a dollar put in a treasury bill in 80 years, earning 3.5%, only grew to $21. And then if you're in a long-term government bond, or think of a long-term CD, like a 5-year CD where you lock it up and they pay you more, you've averaged 5.5%. And then a dollar invested in that only grew to $109. And so in order for you to really see some kind of growth in your money, you have to invest in large stocks, have averaged 10.1%, and small stocks have averaged 12.3%. But that's an average, right? Because it went up, okay, in 1929 it crashed. It went up, then it went down. Then we had World War, what is that, two? And then it went up, and then it went down. And so, over time the trend is up, but what you have to get comfortable with is dealing with that uncertainty, and you have to get comfortable with seeing your money go up and down. Now the market's at an all-time high right now. People say, what do I think the market's going to do? Well, I don't really know what the market's going to do. I don't. But I know over the long term that I'm not really concerned with what it does until I actually need to get at that money that I have growing for me in my future. But I know that my trade-off is that in order for me to really earn dollars, my transmission is still jumpy, huh? Okay, so Wanda, can everybody else hear me okay? Okay. So Wanda, I'm not quite sure what's going on. But so any questions on this chart? Any questions on this? Because fundamentally, this is the basis of all asset classes or investments. And when you begin to understand this concept, then you understand how to make your money work. Okay, so let's talk about that. So let's take those same categories, right? And now let's talk about the power of compounding and the rule of 72. So the rule of 72 says put the amount rate of return that you're earning divided into the number 72, and it'll tell you how long it'll take your money to double. So in this case, I'm taking 30-year-olds that are starting out, they've accumulated 1 year of their retirement and annual 1 year of their salary, let's say in a retirement account. And if you earn 4%, four goes into 72, 18 years. So every 18 years, your money's doubling. So by, 48, you got 80,000. And this is not putting another dime in it, right? Even though you would be contributing, but this is just for an example. And, you end up with $160,000. Conversely, if you just earn 2% more, now your money's doubling every 12 years. Six goes into 72, 12 years, 12 times, right? But the way average annual return, if you're earning 12% and you divide that into 72, it means every 6 years your money is doubling, and that is the power of compounding. So I'm at 80 now. I'm compounding 80 to 160. Well, what happens oftentimes is that we never get to these numbers because what do we have? We have what I call, and what the statisticians call, is leakage. And Ariel and Aon Hewitt, which is a big HR services company, they did a study, and it showed that when participants in retirement plans withdraw from their retirement accounts for other financial needs such as educational expenses, past due bills, or medical expenses, that's what happens. So we never accumulate the kinds of dollars that we could at retirement. And so, what is important is that you put this money to work, you take calculated risk, and you have investments in all of those asset classes I just showed. So you have money in stocks, you have money in bonds, you have money invested internationally. And based on your age, whether you want to take a conservative approach or an aggressive approach, you take 100 and you subtract your age, and that tells you how much you should have in stocks. And then you can start to think strategically about how to place that other money. One of the other charts that I show that I don't have this evening, but what it will show is how over time, when you have your different eggs in different baskets, even if the market goes down, which eventually it is, it's going to go up and down because we're at the highest point right now, then if you take calculated risk, you will be able to accumulate the kinds of dollars. You'll be able to hit that seven-figure portfolio that Mr. Earl did. But the bottom line, in order to do that, is you've got to look at what are all of your options. And so, the first place you want to invest is through your employer-sponsored plans. Some of them even have a Roth 401k or 403b, which allows you to put the money in, and you don't get a tax deduction up front, but when you take the money out, you get to deduct it. And, one of the things I would say about that is the lower your income, the bigger the bang for your buck you're going to get with a Roth IRA. Because if you're in a higher income tax bracket and you get to deduct those contributions, it is going to impact you're going to have to pay less in taxes. And then the next step up is a regular or a Roth IRA. And, it does, again, I'm a big proponent of diversification. So if you're contributing to your employer-sponsored plan and you qualify for a Roth IRA, because it does have income limits and whether or not you can invest in a Roth IRA, that's where you want to look. But I think a lot of things people overlook, we are in this gig economy now, and if you're getting 1099 miscellaneous income, you can open up what is called a SEP IRA. And after you've exhausted all those opportunities, and not until then you start looking at tax deferred annuities where you can put more dollars away. And so this is just designed to show you the different things that you can put in your purse in order to get to that, 10 times your annual income or seven-figure portfolio. And a lot of people say, okay, well, how do you do it? Okay, so this is how you get to this um, $1 million portfolio. Okay, here's the goal. You've got to invest at least 15% of your income. You've got to watch your stock exposure, meaning take calculated risk. And also, if you have a stock that's issued by an employer, you want to make sure that you never put more than 10% of an employer stock in your retirement plan, because then again, diversification. It's so important that you choose more than one mutual fund, and that you learn how to pick the best performing fund. There's a process that I teach all wealth coaching students, and once they're learned, okay, I'm going to let y'all weigh in now. So Gail, Deborah, did you learn how to invest in, how to research and analyze and choose mutual funds that are the best performing funds? I'll let you guys weigh in on that now, because that's the key. The key between you earning 6% versus earning 4% versus working 8%, that's how that compounding happens. And then the other thing, that understand target date funds. Target date funds, basically, they do the asset allocation for you. But that's when you say pick the date that you're going to retire, and then they invest everything for you. Well, the problem with that, if you begin to look at target date funds, many of them sometimes outperform. Underperform putting it in different mutual funds. And then in the last, you need to look at how assets are in your overall portfolio. So not just in your retirement plan, but outside of your retirement plan. And then the key is reviewing it annually. And so is it possible? People always say, oh, well, Deb, that's out of my reach. No, it's not. Because here I want to show you, even if you're playing catch up, this shows a woman who from 1994 to 2014 put $20,000 a year on average in diversified mutual funds of 50% stocks, 50% bonds, and they were just index funds. Throughout, this portfolio earned an average annual return of 7.42%, and in 20 years, she grew it to 21. Now, this is 2013, so by now, especially with the performance of the market, so that's 4 more years, so she's probably at $1.3 million. So the key here is consistency and just, staying the course, but it's having a plan. And so how many of you who registered took my What's in Your Purse quiz? Okay, because if you haven't, did everybody take the What's in Your Purse quiz? I see. You can just type it down here. If you didn't, I will send it to you. Because here's one of the first things you need to assess is, are you on track? Okay? So, Dashelle, you didn't. Kathleen, you didn't. Okay, so I'm going to make sure we send you that quiz so that you take it. So it's one of the first conversations that I have, and it will give you a sense of whether or not you are on track. And here are the questions. Are you maximizing your retirement contributions? Are you aligned with your savings factor? Meaning, remember that, where you should be at different ages? Are you financially savvy? So on a scale of 1 to 10, 1 having no investment knowledge, 10 having full investment knowledge, where do you fall on that scale? Is your portfolio diversified? Meaning, do you have those investments in those different asset classes that we talked about based on the approach that you want to take? And then, are you leveraging all your retirement options? And the question is, can you achieve a 7-figure retirement? And so based on how you answer those questions, it's going to give you a sense of either you're taking the steps and you're on track. If you optimized, and many my students will tell you that's one of the first things that we really look at is, are you optimized in your retirement plan? And then last but not least is if you have five, a lot of times people are doing a few of those things, but they're not doing all of them. And the key to understanding this is that a goal without a plan is just a wish. And so that's why, I came up with the wealth coaching program, because a lot of people, they'll you probably, some of you read my how many of you have read my book, A Purse of Your Own, or Nickel and Dime Your Way to Wealth? Okay. So I wrote A Purse of Your Own 7 years ago. I wrote Nickel and Dime Your Way to Wealth 10 years ago. I updated, and people say, "Oh, I just love that book." And I'll say, "Oh, well, did you do any of it?" "Oh, well, I don't know." Right? And so that's really why I came up with wealth coaching. And wealth coaching is designed to give you the accountability and support that you need. Because one of the things that I've found is how paralyzing fear is. And when we don't know, guess what we do? Not a doggone thing. And so wealth coaching is designed to assist you in not only understanding, increasing your financial acumen, but also helping you to discover what to do. So in wealth coaching, I don't advise. Let's be clear, I'm not a financial advisor. I teach you how to understand the fundamentals of the investment markets and how they work, and then how to take that knowledge and apply it to your individual situation. Because far too often, what happens is people are told what to do, or somebody does it for them. Then, as soon as the market goes down, they get afraid. Guess what? They run for the hills because they don't understand. And I can tell you over and over and over again, I'm so proud of our students. This is my student Drusilla, and when I met Drusilla, she was retired, but she knew she needed to grow her money. And she learned, all of the concepts that I'm talking about tonight, and these are in her own words. She now feels more confident and knows how to make better judgments and financial decisions. And this is Tedra. Tedra was one of my first wealth coaching students. She was pretty sharp, but she'd been to some of my presentations. She said, I knew that I knew just enough to be dangerous. And so now she knows the science and tools, and you learn how to research and analyze stocks. You learn how to research and analyze mutual funds. And even when afterwards, if you sit down with the financial advisor, you're no longer afraid and you know what to do. And so I do have a couple of students on tonight. Deborah and Gail have been with the program. You tell them. I'll ask you, what do you know that you didn't know? If you guys will just weigh in. If you care to, I don't mean to put you on the spot, but the key really is, it's not just knowing. It's applying what you learn. And so at this point, I'm going to open it up to questions. And I just really want to encourage you, no matter where you are on that round, no matter if from a knowledge level on a scale of 1 to 10, if you're a 1, guess what? You can still learn how to take ownership of your financial future. You can do this. If you maybe you feel like it's too late, it's never too late. Mr. Earl, I think he started in his 40s. I have women who are in their 50s. The average person that I deal with is probably in their mid 50s. They're so motivated because they know they're out of time. I have younger people that are sitting with a lot of college debt, and they feel like, oh, am I going to ever be able to? Yes. So Deb said she learned how to build and create wealth, and that's what it's about. Wealth is more than material possessions. Building wealth can give you, I think Emerson said that wealth is the ability to fully experience life. And to me, what wealth is about is not having to worry, right? Knowing that you've paid it forward in your future, knowing that your money will grow because you've done the right thing. So again, let me open it up to questions. Okay, Gail, it was fear at first, But when you have knowledge, you feel more empowered. It's true. It is so true. And I've said it over and over again. I think it's almost by design the way we aren't exposed to the investment markets. I mean, I wouldn't know what I know if I hadn't went into it as a career. I mean, I got an MBA, never covered investment. So why do you think that is? So at this point, any questions? I mean, did this meet some of your expectations? You said we should contribute more than the company match. How much we should contribute? You should get up to that 15%, right? So that's a great question, Deshelle. So let's say the company is matching 3%, right? And you're putting in 3%. So how much will you need to get to that 15%? If you're putting in 3% and the company's matching 3%, that's 6%. So how much additional do you need to contribute in that scenario? Anybody? Come on, you guys know numbers. So that means you should get to another 9%. Now let me just talk about that for a minute, because it's a challenge. So if you're just putting 6% in, right? I mean, if you're just contributing, let's say you're just contributing 6%, and then I say, oh, well, you need to put 9% more in. Well, that's going to be tough, just in terms of adjusting to your lifestyle. So one of the things I really challenge folks is to just move it 1% a year, right? Or if you get a 2% raise, move your contribution that 2% because you're already living on that amount of money, and then you can adjust your lifestyle to that change in contribution. Any other questions? Don't be afraid. The only dumb question is one that's not asked. Okay, let me make sure I'm looking. Okay, so let me just see here. What did catch up mean on your slide? Good question, Deshelle. Man, you looking at the details. So catch up means that if you are over the age of 50, you can use what is called the catch up provision. So, for example, in your 401k plan or 403b plan, the maximum contribution is 18,500. But if you are over 50, you can contribute another 5,500, which means $23,000. If you are in for a Roth IRA, the maximum contribution is $5,500, but if you're over age 50, you could put an additional $1,000 or $6,500. The same would hold true with a Roth IRA. So there's a regular IRA and a Roth IRA. A regular IRA, you get to take the deduction up front. The money grows tax deferred, but when you take the money out, you have to pay taxes on it. Whereas with a Roth IRA, you don't get a contribution. You don't get to deduct it, but when the money comes out, you don't owe any taxes on it. And if I were showing you that, if we were to go back to that chart, and for 10 years you put $5,500 into a Roth IRA, and it grew to, let's say, $100,000, I mean, that's pretty awesome, not having to pay taxes on it. And in addition to that, when you get 70 and a half, you're going to have to pay, you're going to have to make minimum required distributions, meaning, let's say if let's just use round numbers. Let's say you're 70 and a half, you got $500,000 in your retirement account. They're going to base it on your life expectancy, which means you're 70 and a half. Life expectancy for women is 86, so 16 years. So they're going to divide that 500,000 into your life expectancy, 15 years. And so that means you're going to have to take out $15,000 every year. So I hope that explained it. And then Kathleen, I have an annuity, and my company is offering an IRA is offering an IRA, spreading your dollars around. That why it depends. So here's the thing. I'm going to assume, Kathleen, if you have what is called an annuity at work, you're probably in the not-for-profit sector. Are you an educator or work for a hospital? Because a lot of times those plans are so convoluted, just in terms of understanding what you have. So uh, that annuity can be paying you a guaranteed amount, or it could also have mutual funds, or okay, that's your personal annuity. Okay, so yeah, so yes, it's wise to spread your money around. Absolutely. And that goes back to the whole taking calculated risk and putting different eggs in different baskets. Absolutely. Because, I just want you to, I'm going to go back to that chart. And as you could see, if you're earning 4% on that fixed annuity, using the rule of 72, I mean, if you're earning 4%, I don't know how much you're earning, but that's one of the first things that we do in wealth coaching is help you understand what you have, so you can get a sense of, am I making money? What can I expect to get from that? So no, these are all good questions, because that's the other thing you learn. If you borrow from your 401k, can you put the money back in later? Yeah, so you can take out a loan and then you can pay yourself back. Um, but I really want to dissuade you from doing that, because it's hard putting that money back in. I'm going to be honest with you. And if you leave that employer and you got a loan, you got to immediately put the lump sum back in there, or they're going to tax you on it. So I would say avoid that at all costs. Okay, so that goes back to my wealth mindset, right? So instead of thinking about um, you know, diminishing, and that goes back to that leakage problem that I talked about, particularly for African Americans, is once you start doing that, it's hard to stop, right? So I want you to have a wealth mindset and begin to think about what are some other ways that you can create the money that you need. And if that is true, then you probably need to adjust your lifestyle. Yep, Wanda, I know a couple of, and neither of them could afford to pay it back. That's right. And, I'm not saying that, sometimes you're going to have hardships, you may lose your job without any fault of your own. And that's why I'm saying in this new economy, we've got to think differently and be thinking about not only, our current job, but what other kinds of income streams can we create? So in the event things beyond our control happen, we can still have assets around that can take care of what we need. Man, you guys are asking some good questions. Okay, so we're right at 8:30, and I like to keep these sessions to right about an hour. I hope you enjoyed the presentation this evening. Of course, if you want to discuss our wealth coaching programs, just go to my homepage at deborahowens.com and then click on the schedule a wealth coaching discovery session. And then, it's no obligation. You'll get a half an hour with me, and we'll get to talk about what it is you're trying to accomplish. Those discovery sessions are really designed to determine if it's a good fit, and then to talk about the different types of programs that we have. So we have the platinum program is a 10-session one-on-one program with me. The silver are the 5 one-on-one, plus you get access to my online curriculum, all of the books, videos. I love the fact that so many of wealth coaching students, they continue to take advantage of these webinars. They continue to learn and grow. And I just want to leave you with this, that you can do this, right? Like we are, and I know you know this. I don't want anybody to be afraid of what we're going through economically or politically. I do think what I'm excited about is a wake up call, because if anything, what you need to understand is that if you are going to thrive in this dynamic economy, it has less to do with politics and more to do with your mindset. I mean, this is going to come and go. Politicians come and go. But what are you going to do to create your wealthy legacy? We can get all caught up in the social and political aspects of things, and I'm pretty active and I have an opinion. But at the end of the day, I also know that there's certain things that I can control, and there's certain things that I can't control. But what I can control is the knowledge that I'm able to garner, and actually the value that I'm able to create for others. So that's really what this is about. I'm not only in it to win it for myself, I'm in it to help you win it too. But again, hope is not a strategy, and knowledge is not power. Knowledge correctly applied is power. And if there's any way, then I can assist you as I've assisted others who I'm so, so proud of what they've been able to accomplish. Please just go to my website, schedule a wealth coaching discovery session. Let's talk about what you can do to really take ownership of your financial future and build wealth. That's what it's about. So that's going to do it for me for this evening. You guys have a prosperous week. Make sure that you are on my newsletter. You probably are if you're on this webinar tonight. Make sure that you tune in to Wealthy Radio on Tuesday evenings on WEAA. It comes on at 7 o'clock. You can also go to my website, and if you scroll down to the blog, all the um, programs are a podcast of them, so you can listen to them too. Thanks so much. Remember to pay it forward and have a prosperous evening, everybody. Good night.